Hello everyone, hello everyone, hello everyone. So today, I just want to share with you the importance of momentum or the importance of speed in the market, right? So as you know, in the market, as retail traders, we are slave to volatility. That means we need to see volatile movements occurring so that we can be able to make money. Remember that there are two equations that are available in the Forex market, right? So whenever you're trading, not necessarily Forex only, but whenever you're trading, know that there are two equations, right? So those two equations, they are, for instance, number one, the first equation is that high, right, levels of liquidity. The high levels of liquidity is equals to low levels of volatility, right? And then the second equation states that low levels of liquidity, right? So liquidity, it's equals to high levels of volatility, right? So those are the two equations that are more important. So whenever you see movements such as this, right? These movements here, they consist of low levels of liquidity, right? And then these movements here, they consist of high levels of liquidity, right? That's the one thing that you need to understand, because like in the market, when the market starts moving in a range, that means that there are a lot of people participating, and then they are basically buying and selling at roughly the same price range, right? So these are the markets that are not good for you to trade, especially as retail traders, because you can be in a position where you get spiked out more often and then you end up taking losses. That's why we need to take movements that consist of low levels of liquidity, which then results in high volatile movements, right? So the high volatile movements, again, they generate liquidity as well. As price is pushing further to the downside, you've got people coming into the market due to this thing here. We call it FOMO, the fear of missing out. You fear missing out on that volatile move. So by the time you try to enter into that market, it has already moved significantly. So the speed, it has already picked up momentum. It has a strong speed, like it's moving very fast, right? So when you try to enter into that particular trade, you can end up being subjected to a drawdown, having a strong pullback. Like for instance, if you would have taken a short position here, so you see the market when it's making a pullback, you would be ahead as well. So that's why it's very important for you to know when to get into a trade and when to stay out, right? So looking at the GBP USD right now, we had an impulsive move, a corrective phase. We had an impulsive phase as well. So we're currently in a double bottom. We yet to break the neckline of that double bottom, right? So we yet to break the neckline of that double bottom. But every time, look at how the market is moving. After you have such a strong push to the downside, right? That consisted of high levels of liquidity. What occurs is that that consisted of low levels of liquidity. What occurs is that when the liquidity starts accumulating, you start being in a range. Therefore, the speed in which the price came into this area is slowing down. You need to see the slowdown in momentum before you can start considering taking any short positions, right? So once the speed has been slowed down, price then continues again. So there are people who still missed this opportunity, again pushing price to the downside, and they start entering at a later stage around this area right here, right? So similar to this impulsive phase, we had this impulsive phase, and then the speed, it slowed down. So when you start seeing consolidation, that's when you know that the momentum is slowing down, the speed is slowing down. So that's when you start considering taking long positions. If the market is in a bear trend, you start considering taking long positions, right? So you have a retracement. That retracement, its main objective is to slow down the amount of speed or the momentum in which price came into this area. So again, we have another push to the downside. As you can see, the formation of candlesticks does play a key role, because when you start seeing small bodied candlestick, that means that the momentum is low. That means that the speed it's low as well. We've got a low speed, right? So we've got a double bottom here. So again, remember that banks if they are reversing the direction of the trends, they will always try to get their orders placed at roughly the same price range, right? So again, so now we've got a double bottom here. We've got an impulsive phase like this. Looking at it from this side, we had an impulsive phase. So this was a strong push to the upside. So a strong push to the upside resulted in what? Generating liquidity for bank traders to take profit from their initial investment. So now we have this push to the downside. Again, when we have this push to the downside, do you see the speed, the momentum in which price reversed? This plays a key role in determining your next entry. And then you see the long wick that shows a rejection. That means that in this tug of war, right, the bears have more power than the bulls, right? So we can actually expect price to continue dipping a bit further to the downside as well. So now let's look at it from another time frame, right? So looking at this market from a weekly time frame, right? Looking at this market from a weekly time frame, what I see here is that I see a potential of price pushing a bit further to the downside in order to retest the level in which it broke out of, right? So by retesting the level in which it broke out of, it will result in the formation of any inverted head and shoulder pattern, which we know that it's a reversal chart pattern, right? And then again, the length or the distance between the left shoulder and the right shoulder is the one thing that's going to tell us whether the banks are actually placing trades in order to reverse the direction of the trend as well, right? So here we have seen price rejecting the 50% Fibonacci retracement level, right? But we know that the 50% Fibonacci retracement level is not necessarily a golden ratio. So we might have a strong push to the downside where price comes and retest around the 1.2500 price level, right? Because I'm looking at it in terms of momentum. I'm saying, hey, man, the momentum is strong. So I have a strong push right now. We have a strong momentum push to the downside, right? So now we're thinking about, okay, there's a potential that we might start seeing long positions, but the question is that the speed in which prices are approaching this recently formed low, right? How is the speed? Is it moving very fast? Is it moving slowly? Is it you have to ask yourself these questions, because if you're not asking yourself these questions, it will result in you entering a trade a bit too early, and we know that if you enter a trade a bit too early, it will result in a loss. So again, these are the things that I'm talking about, right? So you see a push to the downside. There's a high probability that we might have a push to the downside, because now when you're looking at it, you're saying, okay, this area here, this entire area here consists of a large pool of liquidity. So you see the liquidity located below this area, because when you're looking at this area acted as a support, right? So you have people that have placed long positions here, price push to the upside, placed long positions here, long positions, long positions, long positions, long positions, long positions. Their stops are located around this area. And that area consists of what? High levels of liquidity. That is an area that consists of a pool of liquidity. So you can expect price to tap into this area to fetch more liquidity for long trade. Remember that now when you have this pullback, this push to the upside was a bit strong, right? So the reverse of this push to the upside, it's strong as well. That means that there's a potential that price will go further to the downside. Look at how price reacted upon approaching the daily demand zone. Didn't even try to reject or anything. It's pushing strongly to the downside, right? So now we can expect price to do what? To tap into this area, even go a bit deeper into this area, right? The most important thing that we're focusing on the head. We're saying that the market is considered to be in an uptrend up until it breaks this head, right? So that's one thing that I want you guys to check out. Always make sure that you monitor the speed in which the price is approaching a certain price or certain price level or a certain key area. So for now, I'm still considering short positions. I won't be taking any short positions on GBP USD, because I've realized that if I were to take short positions, we're supposed to be here. So I didn't get an opportunity. My entry requirements were not met for me to take short positions. So now I'll just wait for the retracement to occur, get that potential 78.6, get that potential 61.8 retest of the Fibonacci retracement level, and start considering taking long positions. So that's one thing that I wanted to share with you guys. Again, on the 4-hour time frame, you can still see a push to the downside. It's very, very strong. So just be careful on that. I wouldn't suggest anyone taking long positions on the GBP USD anytime soon.